Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we finished up our discussion of the most basic types of orders that traders use to exit trades in the futures market with a look at the bracket order. In today's lesson we're going to continue our free futures trading course with a look at a more advanced order type which is known as the trailing stop. So let's get started.
Okay, so if you haven't done so already, you're going to want to hit the pause button and click the link above this video where you can register for a free real-time futures demo account so you can follow along with our lessons as well. The purpose of a stop-loss order, as we've learned about in previous lessons, is to protect a trader's account from excessive market movements against a trader's position. The purpose of a trailing stop is to do this in conjunction with locking in favorable market moves automatically as the market moves in a trader's favor. So let's look at how to place a trailing stop order on the Apex Futures trading platform here. Okay, so the first thing that we want to do here is in the drop down menu, which is the same place where we were placing the simple bracket order in our last lesson. You'll see that there's an option there for trailing stop, so we want to select that. The next is we want to make sure that there's a check mark here in this auto box, which means that any order that is executed is going to have this trailing stop, which we're about to define, attached to it once it's executed. So it's important to keep in mind here that that's not only true with a market order, okay, but it's also true if you work to buy or sell using a stop or a limit order, okay? So any order, once it's executed, if we have this auto box checked, is going to have this stop, trailing stop, which we're about to define, attached to it. Okay, so there's three conditions that you can see here on the platform which can be defined for a trailing stop. The first and easiest to understand is the middle condition, the stop loss condition, which is very simply the number of ticks behind the entry price that you want the stop loss order to be placed once the order is executed. So this is set to 10 right now, meaning that if an order is executed, there's going to be a stop loss automatically placed on that order 10 ticks behind the market, or behind the entry price, sorry. Okay? The next condition is the trailing condition, which is to the left. And very simply what this is how many ticks the market needs to move in your favor away from the entry price before the stop loss portion of the order starts to move up behind the market. Okay, so if we have this set to 5, then our trailing stop, which was automatically set at 10 ticks behind our entry price, is not going to move until the market moves 5 ticks in our favor. Okay? The next condition is distance, and let's go ahead and set this to, for example, 5. Okay? And this is how many ticks behind the current market price you want that stop loss to trail once this condition, this 5 tick move in your favor condition, is met. Okay, so if we have this set to 5, then when we execute an order, there's going to be a stop loss 10 ticks behind our entry price, and once the market moves in our favor by 5 ticks, then there is going to be a trail then this stop, which was 10 ticks behind the entry price, is going to move up, so it's 5 ticks behind the market. Okay, so I'm going to help explain this, I'm going to go ahead and go to a slide now, which we can go through a couple of examples of how this would work. For this example, let's say that we've defined our trailing stop conditions on the platform like we just looked at with the following conditions. The stop condition will be set to 10. The trailing condition will be set to 5, and the distance condition will also be set to 10. The first thing that is important to keep in mind here is that each of the numbers we have just set represent the number of ticks, which, as we've discussed in previous lessons, is the minimum movement that a futures contract can make. As we've also discussed, the value of a 1 tick move in the market varies from market to market, so make sure you know how much a 1 tick move is in the market you are trading before using a trailing stop. For this example, we are going to be using the E-mini S&P contract, where a 1 tick move in the market is equal to 0.25 points. With this in mind, a movement from 800 to 801, for example, represents a 4 tick move in the market. Now that we understand this, for this example, we're going to say that I am buying one contract of the E-mini S&P at a current market price of 808.50. As I had the auto box checked, as we just covered, the first thing that's going to happen is a stop order to sell one contract is going to be placed 10 ticks behind the market at a price of 806. To quickly go through the math here, 0.25, which is a 1 tick move in the E-mini S&P, times 10 equals 250. The execution price of 808.50 minus 250 gives me the price level of a 10 tick stop, which is 806. If, for example, the market moves lower from there, then nothing is going to happen to my stop order unless the market trades down to 806, in which case the stop order will turn into a market order and I will be closed out of my position at the next available price. If, however, the market trades up to 809.75, for example, which is 5 ticks above my entry price, then the condition that I have set in the trailing condition portion of the trailing stop, 5 ticks, is going to activate. At this point, my stop is going to move automatically from its original price of 806 to 807.25, which is 10 ticks behind the current market price and the amount that I set for the distance condition of the order. If the market then trades lower from there to, for example, 809, then my stop will not move and will remain at 807.25. If, however, the market trades higher from there at any point to 810, for example, then my stop is going to move up tick for tick behind the market, assuming the market is continually moving higher, so that it will always be 10 ticks behind the market, which would be 807.50 if the market moved to 810. The important thing to keep in mind here is that the trailing stop only moves up tick for tick behind the market if the market continues to move in your favor. If the market moves against your position, then the trailing stop will not move. The math can look a little tricky at first, but if you pause the video here and go over this slide a couple of times, I hope you will see that it's actually very basic. That's our lesson for today. As always, if there's any questions or comments, please feel free to leave them in the comment section below, and good luck with your trading.